Jess, it's December, so I was wondering if there are any year-end money or even tax deadline things that I need to know about, because I feel like I should be doing something right now, and I need to know what the money deadlines are before the last day of the year completely just sneaks up on all of us.
Oh, yes. You should be aware of many year-end money-moving tactics for your taxable and retirement accounts. And for those freelancers out there. And some year-end career money tips. Maybe you've got some budgeting tips too you want to bring, Jessie?
Yep.
Yeah.
Yeah.
So here is what I have for you, Jessie. I separated our action items into what I would consider 5 sections. So first, retirement account deadlines. 2, tax optimization moves for our taxable accounts, because we've got a deadline of December 31st for a lot of items. 3, tactics to consider for small business owners and our freelancers out there. Those with a side hustle. Gig economy is up and roaring right now. Employer-related benefits, things at your job, and then family planning. There's some deadlines for kids' contributions as well at the end of the year.
Well, you know what? I'm going to add one more to that list. And I think it's just good to consider reviewing your debt and spending from the year as a good little financial health practice.
That it is. I like that. That's good.
Yeah.
That's good.
So I'll add that one.
All right. So let's start with retirement account deadlines. Very simple. You just want to max out your contributions. Let's go back to the analogy of the house. When you're on the retirement floor, there is a bouncer at the door. That bouncer is the IRS, and they are saying who can go in and out. That who is being money, how much can go in and out. There is a limitation, and anything that falls onto that floor has a limitation. So that's inclusive of your employer-sponsored plans, which are your 401ks, and your IRAs.
Really?
When you make a contribution to a traditional IRA or a Roth IRA, you can contribute all the way up to the tax deadline for the previous year. But 401ks, you cannot. You have until December 31st, actually, to meet your maximum contribution limits.
Oh, okay. So 401k is the employer-sponsored one, and you can only contribute whatever you contribute till the end of the year. But for your IRAs, you can actually contribute for this year all the way through the end of tax season next year, so April.
You can make a previous year contribution.
Is that just something you designate in your brokerage firm?
That's right. You do.
Okay.
You do. And a lot of times the good ones will have a little tracker and say, you've made this much and blah, blah, blah. But the 401k, you cannot. So what I want you to consider is it's good to max out your 401k contributions because it helps you tax-wise, especially if you're in that higher income tax bracket. If you're expecting a big year of year-end bonus or something like that, you feel like you've got extra income and you haven't maxed out your 401k, that's a great way to reduce your tax situation.
Oh, I didn't think about that. Okay.
So what we're trying to do is offset our income because it's pre-tax income, right? So let's reduce that income amount.
Yeah. Okay. Good idea.
Just plan for your IRAs. Are you going to max out your IRA? Maybe you get your bonus. At Merrill, I didn't get my bonus until February. And so I wouldn't plan my IRA contributions until February. So just know that. Keep that in mind. When are you getting that big influx of cash? I always, anytime I got a raise or a big influx of cash, I hide it from myself.
Yeah.
Pretend it's not there.
Unless it's like you need to pay off some debt or something. You have something specific you really need to do. Yeah.
Oh, for sure. For sure. The same rules of the order of investing apply, which we should link to that episode. And also, Jessie, we need a disclosure. Let's do it real quick.
Yes.
We are talking about taxes. We are not tax advisors. So please consult with your tax advisor.
And, we're not financial advisors either. So
we're not.
Also, consult a financial advisor if you need to.
All right. Retirement accounts. So that's it for your contributions. If you are 73 or older, you are required to take a minimum distribution out of your traditional IRA or even a 401k or a rollover IRA, anything that's taxed like that. If you don't, there is a huge penalty and it's 50%.
And we talked about this RMD word before.
We have, but we haven't had a full episode on it, so it only applies to those who are 73 or older. Think about it, it makes sense because when we're comparing the Roth IRA and the traditional IRA, when you contribute to a traditional IRA, that is before tax dollars. The IRS allows you to grow those funds tax deferred, or you're not taxed on capital gains, but you're taxed as income when you withdraw it. So they're forcing you to withdraw it at some point. And that forcing of withdrawal, that required minimum distribution, begins after the age 73 and a half. And if you don't make that required minimum distribution, and it's a calculation that your brokerage firm can help you with, there is a 50% penalty.
Ooh, that's a big penalty. Wow.
Yeah.
I was not aware of that.
The amount that's required to be distributed. Yeah. And that's a bad one that's a really bad one to miss. And you have until December 31st to do that.
Yeah. Pay attention to what's going on in your accounts and how old you are.
Yes. But when you distribute, it doesn't have to be cash. You can take out stock. You just need to remove stuff from that account.
Oh, okay.
And that needs to be taxed as income.
But that depends on the type of account you have, right?
Well, that's all the same type of account that's going to have a required minimum distribution.
Okay.
So your 401k is going to have the same tax like a traditional IRA and a rollover IRA. Those all fall under the same type of umbrella.
Okay. That makes sense. Yeah, because if it's a Roth IRA and you withdraw,
doesn't matter.
Paying, but do you not pay taxes on that capital
That's
gain?
right.
Okay.
You're correct. Yeah. And it's not taxed as income because it was already taxed as income when you contributed.
Right. Okay.
Yes, the logic there. But speaking of Roth IRAs, what a great segue, Jesse. There's also another deadline. If you are considering doing a conversion from your traditional IRA to your Roth IRA, you need to do that by December 31st. So pay taxes now on that. And that would make sense. Say you've had a difficult year and you're going to find yourself in a lower tax bracket and you might have a large amount sitting in a traditional IRA. What a great time to do a Roth conversion because that's taxed as income. The whole point of contributing to a Roth IRA is you're in a lower income tax bracket and you withdraw when you think you're going to be at a higher one.
Yeah.
That's why it makes sense for those people starting out. The traditional IRA, you're in a higher tax bracket and then you withdraw probably in a lower tax bracket. So if you find yourself in a lower tax bracket and you're not at a retirement age and you've got a lot of assets sitting in a traditional IRA, it might be a good time to consider a Roth conversion.
That's a good idea. True.
Yes. So that's it for retirement.
Okay. So what would the next item be?
The next item would be your tax optimization moves for your taxable accounts.
Ooh, okay.
So moving account types. There's something called tax loss harvesting. Have you ever heard that word before?
No.
So this is where you're going to take a look at your portfolio at the end of the year. And your taxable account, we're taxed on the performance, on the gains and losses. But you're not taxed on that until it's realized. Realized means you have sold or closed the position. So you might see like on your brokerage firm, unrealized gain and loss and realized gain and loss. Right. Unrealized means it's not reality because you haven't sold it, whereas realized means it's sold or closed.
And we're doing what with the realized?
So what we're going to do is you take a look at your realized and you take a look at your unrealized. If your realized is very, very large and your unrealized has a loss in there, let's offset that. That's what tax loss harvesting is. So we're going to sell and close our underperforming investments to offset some capital gains that we have.
Ooh, okay.
That's the point of it. And remember, they're taxed at different rates. So you got to look at that short-term versus long-term.
Short-term versus long-term, as in like when you hold on to something for more than a year?
Correct. Okay. Yes. More than a year is long-term. Less than a year is short-term. Okay. The longer term has favorable tax rates, and they offset one each. It's all like a net at the end of the year in two buckets.
Would someone at your brokerage firm help you with this, or do you have to have a financial advisor?
So this is where a financial advisor would definitely be beneficial. Mm-hmm. And there are a type of accounts like the auto investing accounts where you could select that you're tax sensitive. And if you need to offset gains and things like this, I would expect you to like be very careful with your income if you're in that place where you would need a financial advisor. Yeah. But if this is where it's that one-off where you had a really big gain in Nvidia or Bitcoin, because that happened this year, but you also invested in Alibaba that didn't do so well. So you closed out your Nvidia position and then you may still believe in Alibaba, but you want to go ahead and close that out just to offset some taxes, you could do that. You need to do that by December 31st, just for tax reasons.
Sorry, so the Alibaba would offset because it was a loss.
That's right.
Okay.
Because you just net it together. So say I made $10,000 on NVIDIA, I lost $5,000 on Alibaba. Well, instead of paying taxes on $10,000, the way that your 1099 will net it all together is just a gain of $5,000. Just nets it all.
Cool.
That's just an example. We're going to have another episode on tax forms and what they mean.
Yes. Much needed.
That is the tax loss harvesting. We've never talked about wash sales, so just one thing I want to throw out there. I'm not going to define it today, but if someone thinks they can game the system and said, hold on, wait, so I am going to sell Alibaba December 31st, and then I'm going to go ahead and buy it January 1st, the IRS won't let that happen. That's what creates a wash sale. It's like, don't do that.
Okay, I've not heard of that. Basically, if you think you have some genius idea to cheat the system, the IRS has already thought of that. So
they have. That's true. That's true. They would disallow that. And there's a 30-day period, and that's actually why you don't get your tax forms until 30 days after the year starts. That's why the brokerage firms have to take so long. They have to see if you're going to do that.
But you could do it 30 days after?
You could. Yes, that's fine. That is fine. You just can't buy back the security you sold within 30 days. Otherwise, your cost basis will be adjusted. Yeah. Which we'll get into at some point. All right. Next is charitable contributions. You have until December 31st. Yeah. So you could make qualified charitable distributions, and you can actually do that from your IRA if you're 70 and a half. So you haven't reached required minimum distributions yet. You can donate it to a charity, and that can count as your RMD, and you're not taxed on it.
Oh, interesting.
And you can get stock.
Half. Why do they do these halves? Like, I don't understand.
It's a great question that I cannot answer. So that'll help your tax situation. If you have an RMD and you don't need that money and you want to do some good and you don't want to get taxed, well, you can give it to charity. But know that you have until December 31st. Your FSAs, we haven't talked about these, but these are flexible spending accounts. You're going to know if you have this. This is not an HSA. This is an FSA. Those are accounts for your pre-tax funds that cover medical expenses. Most of them are a use it or lose it type of thing. And you have until December 31st. So if you've got something in your FSA,
see what you can spend it on.
Yeah. And normally there's a list like of things from CVS and stuff like that.
Yeah, stock up on your medical supplies or whatever.
And then if you're thinking about your HSA, no, you have until tax day. So we don't have to worry about that just yet.
Oh, that's good. Yeah.
All right. That's the tax optimization moves.
So next would be income deferral and small business strategies. I don't know what income deferral is. Do I?
Yeah, of course you do. 'Cause you're a freelancer. So you signed a contract to do something, and maybe you've had a really great year as a freelancer. You might want to push it off more income and not bill until January.
Defer the income. Got it.
Yes. Kind of like that. Defer your bonus compensation a year out, depending on how your year is, to help with taxes.
Yeah.
Unless, your client wants to do it by the end of the year, then obviously, do it right by your client. Okay. And then the same thing with business expenses. If you've got a big expense like supplies and subscriptions that, you're going to make, let's do that by the end of the year so we can offset that income.
If you have any like office products you can buy, if you're in the market for a new computer or something, that's a big expense. If you know you're going to have a lot of taxes, you need a good write-off. Think about it now.
Because even though we don't do our taxes until April-ish, there's a lot of deadlines December 31st.
Yeah. Good point. Good things to think about.
So that's it for income deferral and small business. That's it.
This is just another little small business thing because it's top of mind for us. Don't forget to submit your BOI report before end of the year if you have an LLC, and you can ask your tax accountant about that if you don't know what we're talking about. But that is also before, you have to do that before December 31st, and that's a new thing. So
that it is. There's a really big fine a day too, isn't there?
Yes, per day you get fined. So y'all really have to do that before the end of the year.
Yes, you do. All right, next is employer-related deadlines. This is a good one. We don't talk about career tips and tricks, But Jesse and I have navigated the corporate world, and we both have got some really good tips and tricks. So if you would like an episode on that, please let us know. Have to understand the intent of the system, right?
Mm-hmm.
For sure.
If you understand how the stock market was just a bunch of companies and they care about their margins and profits, then you can kind of understand the corporate world and like your job and what those companies you work for care about too.
So true. You are just a number. Really are. But for your employer related deadlines, if you get a year-end bonus and you know it's figured by the end of the year, those year-end reviews, know that you're just a number. And if you want a raise, you need to make sure that you tell your manager that you want one. You always say, what do I need to do to get that, and document it and create this paper trail. That's really important to do. But if you do get that bonus, think about retirement account or savings. Don't just spend it on something that you don't need. Think about future you.
Having a plan for your money.
Yeah. All right. Last thing with the employees is check your employee benefits. If you have expiring PTO that's not going to roll over, let's consider taking that.
Yeah. Use those days.
Yes.
Yeah.
If you have a wellness stipend, at big corporations especially, there are usually a ton of stuff a year, even like on your credit card, that you have until the end of the year to use. Go through your benefits portal and see what you have. It could be little things like make sure you maximize that.
Yeah. Use everything they're going to give you.
Absolutely. That's the purpose of the benefits. They're trying to attract you and retain you as an employee. That's right.
What about stock options if an employer gives you those?
Yep. If you've got an expiration on that, make sure you double check that if you have those stock options.
If we haven't done expiration, like a vest, and then you have to exercise them or something.
If you've got a period or something like that, I think we could have a whole episode on that. And then the last category is family planning. There has been a lot of asks to talk about certain family planning type of accounts. And I don't even know if I like to use the word family planning for the kids. You can be an auntie and open these up. But 529 contribution plans specifically, the deadline varies, but these are the education savings plans that give you state tax deductions. But most of them have a deadline of December 31st for their contributions. Or even distributions. So I would definitely check your 529 plan.
Let's do an episode on that. Like you're saying you get your personal tax deductions if you open a 529 plan for a kid?
No, there are limitations that you can put into them. They're used specifically for college expenses. Some can be transferable, some cannot. There's even like this new plan coming into place with converting to Roth IRAs even. But since it's kind of under that umbrella, it's got limitations of going in and out because it grows tax deferred.
I see. Yeah, let's do an episode on that for sure.
For sure. And then annual gift tax exclusion. If you are a wealthy person and you are giving gifts to someone else, you have a limit to it. You just can't hand people money without it being taxed. And that's $18,000 per person.
Per person.
Per person.
That you give a gift to.
Correct.
If you are out there listening and you're wealthy and you would like to give a gift to me or Jess, we would gladly take it. Or I know I would.
Sure. Yeah.
But that also counts as income for the receiver, right?
Without the gift limit. I don't know. I actually don't know how that works. We have to look that up.
Oh, our tax accountant, Catherine at Prisma Tax, has content around this. When you receive gifts from people, the money form, I think you do have to count that on your taxes. Don't quote me on that. I'm not a tax accountant, but yeah, we have a tax accountant that makes content on that if you get gifts a lot.
Right. Good point.
Yeah. And I know that you said that was the last one, but here's the one I'm adding. And I just would like to tell you all, it's a good time of year to review your debt and spending. So debt, it's a good time to look at your budget, your spending, your debt and savings. This is basic personal finance that we don't often talk about on the Self-Directed Investing Education podcast. However, it's a good practice this time of year. Think about, did you make any progress on paying down your debt this year? Do you need to look at consolidating? Pay attention to rates. Review the terms on any outstanding balances to make sure you have the best possible rate. In episode 64, we just talked about how the credit market influences your loan and credit rates, the yield curve. We give you tips on calling up your credit card company to ask if interest rates have come down and they can lower yours. So check out that episode and definitely look at your debt because, obviously you want to pay that off the best way possible so you can put your extra money into investing. And then I'd also say to just look at your spending this year. Did you have a lot of frivolous spending this year that might have served you better if it went into your investing portfolio instead, perhaps? I mean, listen, Jess and I love our fair share of retail therapy, but if you feel like maybe you overconsumed this year, consider buying a stock in that brand you love instead of buying another clothing item or accessory you don't really need. Or you can take half of what you would have spent on buying stuff you didn't really need at Target, for example, and put that in a passive fund instead. Like that's just some food for thought. Yeah. You could maybe make a little budgeting, spending, investing spreadsheet someday, Jess. I don't know.
I would love that. I'd want to make it interactive though, where you'd say, I spent this much at Starbucks, and then it would say, here's what it would look like if you invested that much at Starbucks.
Yeah. And we're not saying don't enjoy your life and spend your money. Obviously spend your money and do the things that bring you joy. But,
Yes.
Again, have a plan for your money. Make sure you're not not taking care of future you, So
Agree.
Something to think about to start planning when you're doing your New Year's manifestations and vision boards and goal planning. Think about all those things,
Absolutely. Especially when people are going in to buy gifts this year. I think that's a good reminder.
Okay, well, we can do a quick recap of what we just covered today and hit those year-end money deadlines with confidence. Retirement accounts. Max out your 401k and IRA contributions. Remember, the 401k deadline is December 31st, while IRA contributions can go until tax day of next year. But don't wait if, try to get it done. Take your RMDs, your required minimum distributions, if you are 73 years or older to avoid penalties. Those are hefty penalties. And consider a Roth conversion to lock in tax-free growth for the future. Those are all, this is December, so start looking at it now. Tax optimization moves. Use tax loss harvesting to offset any gains. Make charitable contributions count by donating before December 31st, and bonus points if you use a qualified charitable distribution from your IRA. Spend down any leftover funds in your flexible spending account and your HSA while you're at it. Make sure you got all that spent. For freelancers and small business owners, if you're self-employed, consider deferring income until January if possible to lower this year's taxable income, and then prepay 2025 expenses now to get a deduction for 2024. And don't forget that BOI report. Very important. And then your employer benefits and personal finance. So use up any employer-provided benefits like PTO, wellness stipends, stock options before they expire. Those are benefits of you working as a hardworking employee for that company. Make sure you take advantage of all of it. And then contribute to those 529 plans for the kids, for education savings, and take advantage of the annual gift tax exclusion before December 31st. And don't forget to review your debt, your budgeting, your spending this year, and see what needs to be adjusted for 2025.
Love it. Well, that's it. These steps can help you save money, lower your tax bill, get a jump start on 2025, start it out coming in with a bang. I don't know. How do people say it?
Yeah, going out with a bang. A bang.
I'm really disappointed in myself for not having a Taylor Swift lyric at this moment.
I'm very shocked, honestly.
I am. I am. Don't worry, Jessie. I will make up for it.
I'm sure you will. And as always, we'll link to the resources in the show notes of everything we mentioned today.
And of course, if you found this helpful, please do not keep it to yourself. Share this episode, share it to your story, and help us spread the financial literacy, literally.
Or take a moment to give us a 5-star rating, or tell us how you really feel and leave us a lovely review.
Yes, and we will see you next week. Remember, when you build knowledge,
you break barriers. Thanks for listening to Market MakeHer.
We are not registered financial advisors and do not provide personalized investment advice. Any information provided by Market Maker on our website or podcast is not intended to be a substitute for professional financial advice. Market Maker is not liable for any investment decisions made based on our content.